Good afternoon, everybody. Happy New Year to all of you. It's 3:25 on January 2nd. Today is Tuesday. Hope you guys are well. Okay, so markets actually were interesting today. The Nasdaq had a little bit of a breather, down 1.6%, 245 points down. This was kind of expected given how well the market has done. I mean, just to give you context, the Nasdaq in 2023 was up more than 50%, which is twice the performance of the S&P 500 at about 20 something percent. S&P 500 today down about 27 points, 0.5, 0.6%, not too bad at all. And then the Dow Jones was up 0.07%, 25 points up. So I wouldn't call it rotation yet, but it's just NASDAQ taking a breather after a phenomenal 2023. Just taking a little bit of a breather. In the same time, Nasdaq Russell 2000, which is a small cap index, also not down a lot, down about almost a point or so at 0.6%. So not too bad at all. Okay, so one of the stocks that showed up on the radar is JPMorgan Chase. And to give you a little bit of context, JPMorgan Chase has been performing very, very well, no doubt about that. But more importantly, as interest rates start to get normalized, meaning they will come down this year from the current Fed funds rate of 5.5%, there's predictions from multiple people to it might go down to 4%, and the average or median is about 4.5 to 5%. That's the median, if you will, in terms of the Fed funds rate. In an interest rate environment that is lower, typically JPMorgan Chase should do better. So interest rate sensitive stocks overall, whether they're fintech stocks like SoFi, Affirm, AFRM, Upstart, solar stocks as well, which have been hurt a lot in 2023 because of interest rate environment that we're in, should do better technically, but it all depends on how quickly the interest rates move down and how much they impact the first half or first quarter of the year as opposed to the later part of the year. Okay, so let's go through our five-step process with JPMorgan Chase. Again, as I mentioned, I'm not just going to go through simple stuff that everybody knows about. I'm going to talk about a specific setup and see why it is working to give a little bit of more context on an overall basis. Okay, we always start with the fundamentals and financials over the longer term. 2016, if you will, JPMorgan did about $100 billion in revenue, and it's almost going to double. Trailing 12 months is going to double. So it's going to double in the trailing 12 months basis. 2022, it's gone up about 30%, but 2023, if you look at the trailing 12 months also, they're nearly going to be doubling from 2016. So this is good growth overall, especially for a company this size. This was about 7% growth, another 10% growth. They've been consistently growing. This is, except for the 2021 timeframe, this was probably because of the COVID challenge, where they literally did not grow, less than 1%. This is strong growth. This is nearly a 20% growth. So this year they're going to grow again. Interest income is most of the revenue. So just to give context for a lot of people that don't quite understand, the way banks make money is very simple. They borrow from either depositors, people like you and me, who might take our savings or might take our paycheck and put it in the bank. Let's say I make $50,000 a year. I put that in the bank, direct deposit, and I actually spend about $25,000, $30,000 a year. The remaining savings, sometimes some people invest, some people just keep money in the bank. So they get deposits from investors or some from consumers. They put it in their savings account. Some people keep it in their checking account as well. That money, they pay out an interest rate which is much lower than the rate that they loan to you. So for example, $50,000 I put in the bank and I spend, let's say, for example, $35,000, I got $15,000 saved. Traditionally, you'd get 1%, 2%. Last year, of course, I got a lot more. It was closer to the 4% range APY, annual percentage yield. But 4% is what you get. Whereas if you want to go take a loan, whether it's a home loan, which is going right now at about, last year went about 7%, now it's about, yeah, it's about 7% as well, 30-year fixed mortgage. Or if you want to take an auto loan, it's even higher, it's 8 to 9%. If you want to take a personal loan, that's probably 10%, 12%. So interest rate income or interest income essentially is the differential between the amount of money that you pay them for a loan that you take versus the amount that they pay you for the money that you save. So they made most of their money, as you can expect, comes from interest income. Net interest income is about 66%. In total interest income for the banks, this is essentially paying to the Fed. So sometimes they can't get enough deposits. They've got to go outside and grab the money. They've got to pay a little bit of money. So this is also what they pay out. And then they also make provisions for losses. So some of the people may um, declare bankruptcy. Some of the homes may go under. So they keep loss provisions typically in the 3%, 1% range, depending on how. And big banks such as JP Morgan are expected to keep a certain amount of what they call stress test, certain amount of cash and certain amount of reserves just to be able to service the loans, service the debt. So net interest income, operating income is about 47%, 47 billion. Sorry, this is about 30%. So their operating income is about 30%. They don't have gross margins, they have operating income. And then pre-tax income is about 40 billion, net income is about 30 billion. So on the top line of 157 billion, they're making 37, 40 billion, almost about 30, 40% solid cash. Of course, this has gotten better and better over the years. So technically speaking, they're a very strong revenue company. This has been growing very well. Let's look at it from a quarterly basis. On a quarterly standpoint, again, it's gone from 33 billion to double that in about a year and a half, almost 2 years. It's doubled that. It's gone from 33 billion was low to about doubled it. So JP Morgan has done exceedingly well, guys. On a $66 billion total revenue base, the net income is about 13 billion. So they're doing margins roughly, if you take it to go in the 20% range, net margins in the 20% range, very strong business. Let's look at making sure that they have enough cash. They're a bank. They're a big bank. They're one of what they call the banks that won't fail. The US won't let them fail. And look at they got 1.89 trillion, $3.89 trillion in assets, which includes deposits, which includes their trading account, includes everything. And the liability is about 3.6 billion. So after the loan, tier one capital. So this is a little bit more complicated balance sheet. I'm not going to go through in detail. I understand this. I'll tell you a little bit about what are the things that matter in this more than anything else. They should have enough coverage service to bank to be able to service the cash. And I'm going to find out why it showed up on the radar. Besides the fact that they're growing revenue solidly, they have enough cash flow from operations overall. So I'm not too worried about that. Let's look at some of the valuation ratios and margin ratios. So margins, operating net margin is at 20%. Gross margins are in the 40% range. So you can't complain about it really too much. They're pretty strong. Okay, so price to earnings traditionally, let me give you a little bit more context on JP Morgan. 10.15 is the PE ratio for JP Morgan. Came down significantly because if you look at the last 20 years, let's look at it from an annual basis, just a little bit. So mean reversion is the reason probably for the trade over here. If you look at it average, it's about 11.93%. It's down to about 10%, sorry, 11.93x. This is 10 times price to earnings. This is low compared to their norm. So the reversion to norm should be closer to the 11 range. On the 11 reversion range, if the PE on the PE side, you should get to somewhere in the market cap of what 530 to 550 billion. That's about another 10% to 20% from here, 15% from here. So this is that kind of a trade. It's $172 stock. A 10% move is about $117 to $20. I would say that's probably the reason why it's showing up more there as a mean reversion trade. Historically, just to give you a little bit of more context on why I think this is very interesting, let me talk about JP Morgan. 20 years, the average historical PE is about 11.79, 11.8 or so. Today, it's 10, in the 10 range. And on December 2022, if you remember, a year ago, excuse me, this was even the 10.31 range, made it up all the way to 11, and then it's gone back down again because of interest rates. Traditionally, it should be in the 11.3 range, in fact, much higher in some of the years if you see. So you should get to the 11 range, which gives you a lot of room to be able to go up. So this is a good swing opportunity in that sense. To give you context, in the last 20 years, the highest PE ratio of JP Morgan has been is in the 19 range. So this is a 10 PE right now. It gives you a lot of room, especially if they start cutting interest rates a little bit faster. You should expect this to go up pretty quickly. I like the fundamentals basically. JP Morgan is difficult not to like the fundamentals. Strong company, very well run company. So I'm going to talk about one other thing today, which is what is the longer term trend and what is the shorter term trend. The longer term trend is, so one of the things I get asked questions fairly frequently is which time frame should I use with charts? Use the time frame for the time period you plan to hold. So for example, if you plan to hold it for days, then use the daily chart. and then use two other time frames before, you get a multiple time chart view. So daily, weekly, monthly, that's the way to go about it. Okay, so this is monthly chart. The monthly chart, it was growing up steadily. It went up all the way during the 21 time frame, took a breather in 2022, everybody did, and now it's hitting back to the all-time high. So where is it? On the long term, the major trend line is still up. Higher highs, higher lows. That's what a trend line basically looks like. This is very, very strong. So it's getting back to its all-time highs. Okay, now let's go to the weekly chart. That's where it is. It's coming up against resistance. If you look at it again here, that's one of the things that you've got to be worried about. But essentially, it's gone past that little bit. It seems to have been at the hit. Now, if it takes a breather from here, which it might, that still is a cause for concern. But I think this was probably going to go a little bit higher. This is probably going to go ahead towards the 175, 185 range, and after that, the room for it to go to the 11 PE range is probably in the 200 range, $200 range. So short-term trend still up, but this might be, so this was the one, look at this. This is the head, shoulder left, shoulder right, heads down. This is making another attempt. This could have done a shoulder left as well. Shoulder left into a shoulder right. So now it's heading back up again. This is a strong move up. So the medium-term trend is also very, very strong. This is the second trend line that we can draw. I'm going to fine tune it a little bit. The big challenge is on the weekly, it could get into a multi-year pattern, which might be a little bit of a challenge. Right now, I'm not too worried about it. I think it might, but still gives you room to be able to move. So this should move up. JP Morgan is a good trade. I think you want to wait for it. The big challenge, let me see, 164 is the 20-day moving average. Don't see, oh, there you go. Oh, it's very, very, so 164 and then 141. So you want to wait for it maybe a little bit to consolidate in the 170 range. And then this is going to go to 175, 185 fairly quickly, I think, in the next couple of weeks or so until earnings. And then earnings is expected on, let's see, Friday, January 12th. So before earnings, this might be a good trade. After earnings, also, it might actually be a good trade. You want to wait for earnings. Don't trade, don't hold it during earnings. I just advise you not to do that. But this is going to be a good trade. Watch for the earnings. Before earnings, it might get to 175. That's a small trade. You make a little bit of money. But the more important trade is just wait for after earnings, and then they should go up and to the right. Strong balance sheet, strong, good interest rate environment, good move in the stock, very strong chart. You can tighten up the chart a little bit more, I'm sure. The only thing to worry about, the reason why I'm not suggesting take a big position, is only because of the multi-year head pattern. Look at this. This is it's going to go up against the 2021 October high. So that might mean it could take a breather, but I'm hoping it actually gets a little bit up and to the right after that as well. Thank you very much for watching. I appreciate you guys. Let me know what you think. Happy New Year.